Here are 4 stocks that reported this morning, and many of them are having some crazy whipsaw action. Some are up 10% at this time. So let's look at them. Dick's Sporting Goods, Best Buy, Dollar Tree, and Baidu. So looking at Dick's Sporting Goods, this is a stock that I've been very interested in for quite some time. And the reason is, where I look at it from a person that purchases stuff. I just bought a pair of shoes from Dick's Sporting Goods. These pants that I'm wearing, I bought from Dick's Sporting Goods. It's a great place to go. They did an awesome job transitioning into curbside pickup. When COVID happened, they were the first ones on the mark. They have all of your sporting goods needs. When you go and buy some type of sporting equipment, for me, I like to try it. When I played baseball, I like to put the glove on and try it before I would buy it. When I want to wear a pair of shoes, it's very convenient for me to go there and just try on a pair of shoes. So let's go, and especially golf. I shop there a lot for golf. Plus, they own Golf Galaxy. So there's one thing here that concerns me about Dick's right before I go to the 8 pillars. Dividends paid. Dividends paid $621.67 million, and their 5-year average is $707.6 million. Their current trailing 12-month free cash flow is about $380 million. That off the rip concerns me a lot. That is a very strong dividend yield. I assume that they're going to have to cut that at some point. Now, admittedly, I did go through this. Excuse me. I did go through this in a deeper dive in one of my oracles of EM, so I have a pretty good idea of what I'm looking for. There was nothing else that was glaringly standing out and saying to me, hey, you shouldn't buy this except that dividend. That dividend was very worrisome. And I should say this too. Just retail in general. Where's retail going to go over the next decade in general? Is it going to be more online? Granted, they have a great online presence. So looking at the 8 pillars real quick, the debt, it's really not terribly concerning for me. I bet a lot of this has to do with capital lease obligations just because they rent a lot of their spaces throughout the country, and their cash flow. The cash flow is a little bit concerning for me. Let me go and see. Did they do an acquisition of some sort? I cannot remember off the top of my head. Not seeing that on the cash flow statement, but go figure that out. I just can't remember what the reason was, but to me, Dick's Sporting Goods needs to fall a little bit more. Right off the top of my head, again, I think it was about $80 to $90 range, but do some more digging on that one. The next one, Best Buy. This is a massive tech space competitor to Amazon. Now, a lot of people will say, well, maybe they're really not as big as people think. I like going and trying computers and headphones and whatever else in the tech space that I'm going to be buying before I buy it, usually. And that is what is great about Best Buy. Now, they came in and reported earnings of a revenue beat, $10.58 billion versus the estimated $10.31. Earnings per share, $1.38 versus $1.03. So they did very well. They are, however, saying that their same-store sales are going to continue to fall as much as 11% over the next year. And that reason is they're coming off of this crazy COVID high. I mean, when they were up here doing revenues and store sales up at these levels, it wasn't sustainable. So I look at these kind of companies and say, well, is it really a bad thing that everything's falling apart on them? Or is it just coming back to reality? I mean, when you go from doing revenue of $43 billion to $52 billion, a massive jump. And you could see here, it was consistently $39 to $40 billion every single year. 43 billion, 43 billion, 43 billion, 52, 49. To me, they're just going to come back to these types of levels. And for me, that's perfectly fine. You don't have to have insane growth to have a good company to buy. So let's pull up the 8 pillars on them. A lot of people in our community like it. Outside of the cash flow, it's pretty good space to be in as far as the 8 pillars go. Their dividend, they pay $735 million. Current cash flow, you can see it's been a little bit wonky lately, $824 million. So that's a little bit high, but based on the 5-year average, it's not terrible. I would like to see that a little bit lower, but maybe for such a stable company that's been around for such a long time, Best Buy is okay paying a dividend that is that much of their 5-year average free cash flow. Okay, next, Dollar Tree. A company that is probably really good in a recessionary environment. Just right off the bat, I want to go here and go back to 2007, 2008, 2009. We saw, here was your recession, $3.73 billion, $4.62 billion going into 2008, 4.56, 5.06, 5.72. So you can see that even through the financial crisis, they did not skip a beat. This is the place where people went where they needed to find cheaper items. And Dollar Tree is a great option for that. They came in, reported revenue of $6.94 billion versus $6.84 billion estimate, $1.2 billion in earnings per share versus 1.18%. So what does that tell you? That's a beat on top and bottom line, and the stock price right now is down over 10%. For you traders out there, this is why you don't trade earnings, because of forward guidance. Now, looking at these 8 pillars, it is a disaster. Overpriced, in my opinion, on the 5-year price to free cash flow and 5-year PE ratio. The debt situation is not good. They're buying back expensive shares, which I don't like. Their cash flow is being disseminated. They have revenue growth. Net income growth, however, is falling. Let's go and see what that is exactly from. Some type of anomaly situation. No. They are, no. Okay. Earnings per share. I really don't like that they're buying back shares at these types of prices. So for me, just based on looking at that, the 5-year PE and the 5-year price to free cash flow, probably out for now, and I'll probably let it fall. If I had to guess, in half, $75, $70, somewhere in there. Now, Baidu. Baidu is down right now, 1.73%. Revenue came in beating $32.54 billion versus $31.54 billion. Not sure if that's in their currency or U.S. dollars, but either way, it's a beat based on the conversion. U.S. earnings per share, $2.37 versus $2.15. So this is, of course, an interesting stock to people. Paul has done a tax loss harvest on Alibaba for 30 days, bought Baidu, and it is working out pretty well when you look at the two to be in the same category. Now, it's not surprising that their 5-year price to free cash flow and 5-year PE are lower than 15. Now, I don't like the discrepancy between the two. Those should match out, but it is still a growth company where I'm not totally turned off by having these two just a little bit from each other. Now, return on invested capital, I don't like that. To me, like I said in the video yesterday, when I see return on invested capital out of a big company, I like to see it higher than 9%. And the reason is because that tells me how management reinvests the money. Monish Pabrai says that he looks for 3 things when he's looking for multi-baggers. And the first one on his list is a high return on invested capital on their own money, not using debt. So right off the rip, when I see something like that, I go, maybe there's a better option out there. For me, I don't own Baidu. But let's see what the analysts have to say about this company. Going out to 2026 earnings per share, it's about mid-teens earnings per share growth. And revenue growth, if I had to average it out over 5 years, it's probably around that 7% range, 12.45% next year, 11.5% in 24, and then it continues to decline. But let's see, did they have any big COVID spikes in 2018? They did 13.6, 14. So they did have kind of big growth coming out of COVID, but nothing absolutely absurd. All right, let's run it through Stock Analyzer here. Let's put in 3, 5, and 7 for revenue growth, and I'm doing a 10-year analysis here. Profit margin, I will go with 14, 17, and 20%. Free cash flow margin, I'm going to do the same. I think that those should balance out over a long period of time. PE, I will go with 14, 16, and 18. Same for the price to free cash flow. And my return, because my revenue growth is so low over a decade, I'm going to go 12.5, 15, and 17.5. Because 7% revenue growth, 20% margin, it's not totally out of the realm, but if I'm going to invest in a company like Baidu, I want to get some type of really good return on my money. Click the Analyze button. Current price is at $92.99. And if you look at it, here you go. $83 on the low end. We're almost there. High end, $130. Middle ground, $106. So I see the value in the stock. The question is, do you believe in this company long term? Do you trust the numbers that are coming out of China? All these different things can come into play when you're looking at this type of company. Guys, if you like videos like this where we do instant reactions to earnings, we talk about other educational things, subscribe to the channel. See you next time.